Welcome back to the show, everyone. Today we have a little bit of a different guest, but all the more valuable here. And he's the CEO of the Smith Manoeuvre, Mr. Robinson Smith. Robinson, you can find his book online at smithman.net. The book is titled Master Your Mortgage for Financial Freedom. And he's coming from Souk, British Columbia, talking to us today. Robinson, how are you?
I'm 100%. How are you doing, Robin?
I'm doing very well. So, as your father, I believe, leading up to the establishment of the Smith Maneuver, it was like the '80s, I think, the early '80s, that Fraser finally established the maneuver. What was the catalyst where he said that this is something that we have to introduce into Canada?
Yeah. Well, my dad became a financial consultant back in the early 80s in Vancouver, and he was looking for a bit of an edge. A lot of financial consultants, financial planners out there. And he basically, when he was looking for something that he could offer his clients, he came across, the fact that we Canadians cannot deduct the interest on our mortgages on our principal residence, whereas the Americans can. And he didn't think that was very fair. So he brought the Tax Act book out and read all of that, and he came up with, taking a number of different pieces in the financial landscape of a Canadian, those being taxation and mortgages and investing. And he came up with the strategy whereby he could effectively allow the Canadian homeowner to come up to par with the American homeowner in the fact that we could now deduct the interest on our Canadian mortgages. So this was developed by him early on. By the mid 80s, it really started to gel, and he wanted to get this formalized into a strategy. And he went to a number of bankers in Vancouver at the time, a bunch of big banks, and spoke to the managers there. I've got this idea for the strategy for Canadian homeowners, and here's what it is. And they all sent him home. Bankers, they were stuck in their ways. They were middle management, leading a branch there or something like that. They didn't want to poke their head up and offer something new to upper management. So they said, this is unusual, it's not normal, so we're not really interested. But what happened was Dad thought to himself, well, I got to get in touch with the CEO of a financial institution. I can't just talk to someone in the middle. So he called Van City, asked to be put through to the CEO, and Larry Bell picked up the phone on the first ring. And so Dad went in for a meeting with Larry and explained the strategy he'd come up with. And as I mentioned in my book, Larry pushed his chair back and said, why isn't every Canadian doing this? So Fraser knew he made a new friend, and they cooperated together to enable this strategy to be functional for Canadian homeowners.
So through your dad calling Larry at Van City, did Van City introduce what's now referred to as the readvanceable mortgage? Is that the
No,
result of the conversation?
no, I have heard it told to me by financial professionals in the mortgage industry that is why readvanceable mortgages came out and were developed, is because of what my dad had come up with. But Van City never really came up with a truly readvanceable mortgage. They didn't exist back then when my dad was talking to Larry. Effectively, what they had to do was, it was clunky at the time. It was still well worth it for the client, but it wasn't slick and smooth the way it operates these days. Readvanceable mortgages came significantly later.
So pre-advanceable mortgage, what were the mechanics of the Smith Maneuver? How did you actually carry it out? Like, I'm curious.
Yeah, the the way that it operates now with the readvanceable mortgage that you mentioned is the homeowner is able to access the equity as fast as they're paying it down on their mortgage, that non-deductible expensive mortgage debt. They're able to re-access the equity that they're creating with that mortgage payment, and they can pull that equity back out and get it invested, and do that each and every month. And this can be done online or as a phone call, so it's relatively simple to do. It's actually quite slick. But back in the day, as we mentioned, these types of mortgages didn't exist. So Larry at Van City said, okay, here's what we're going to do.
Mm-hmm.
On a periodic basis, Fraser, I want you to send in your client's bank statement. And it didn't matter if they were with Royal or CIBC or whatever. So Dad would do that. A lot of paperwork, a lot of communication, all that stuff. He would send the mortgage statement over to Larry, and Larry would say, okay, since I last extended some credit to your client, Fraser, they've paid off another $5,000 of that mortgage. So I'm willing to increase the Van City line of credit by that amount, and the client could pull that out and get it invested.
That's really interesting. And today, because everything's digital, it's quite simple, and you have that product, the re-advanceable mortgage. When someone walks into a bank and either starts up a new mortgage or they renew their mortgage, when they talk to someone at the Big Five, an advisor, what do they ask for?
Well, if they don't know about the Smith maneuver, they're asking for a mortgage and they're asking for the best rate. And if they walk into any big bank, that mortgage specialist is duty bound by their employer to say, here's the best mortgage for you. Of course, it's going to be that bank's mortgage. And it may be a readvanceable mortgage or it may not be. And there are a lot of Canadians out there who have been sold a readvanceable mortgage, but the bank mortgage specialist on salary has not explained any advanced financial planning or strategy with this mortgage. And so the homeowner with this type of mortgage, they get their first mortgage statement or second or third, and they notice they've got available credit that keeps on rising. I don't know what's happening here. I'm paying down my mortgage like every other Canadian, but I keep on having more credit available. And you know what? Each month it's about the amount of a BMW payment. So great. I'm going to go and take that money each month that they're giving me and buy a car or a motorcycle or go on vacation or spend it at the cake. And because they haven't been taught how to use this type of mortgage most effectively. And so all they're doing is they're paying down expensive non-deductible mortgage debt on this side and borrowing back expensive non-deductible debt on the other side. Mm-hmm. And what are they doing with that borrowing each month? They're buying assets, if you will, that are declining, depreciating in value as soon as they bought them or disappearing in value completely. Right?
So the key is obviously
the same amount of debt that we had when we got this type of mortgage, but we don't have all those assets that we bought, that we borrowed money with.
Exactly. So I've heard you use that term before, like debt equity, like you're building equity in your home as you pay down your mortgage, right? And what's the use, right? You can invest that, so you take it out in the form of a HELOC. Obviously, you're going to be charged an interest on a HELOC when you take the money out, but the key is to invest it and invest it well. Now, interest rates went like sky high. They're still quite high historically. Does the Smith maneuver still work? Because you're really looking for that spread, right? And a net gain. Has it changed? Has the effectiveness of the maneuver changed?
Now, we haven't really talked about what the Smith maneuver is and how it functions for your listeners, so there may be a little confusion at this point, and I'm sure we'll get into it. But basically, the beauty of this strategy is that it works when interest rates are high or when interest rates are low. And when we talk about how this actually functions on a monthly and annual basis, you'll be able to listeners will be able to make the connection here. But when interest rates are low, we have more to invest each and every month, starting now, starting right away, not waiting for our house to be paid off before we start investing for our future. We start investing now. So maybe I've got $1,000 to invest thanks to implementing the strategy when interest rates are low. When interest rates increase, I don't necessarily have $1,000 to invest each month. Maybe it's $950 to invest, but my tax deductions get bigger. My tax deductions are bigger. My tax refunds are bigger. And those tax refunds that this strategy is generating for me is what I'm using to make extra payments against my mortgage. So whether rates are high, whether rates are low, the strategy functions beautifully because we've got two wonderful things happening here. We've got tax deductions, and we've got the amount we can invest each month. And when one goes down a little bit, the other increases a little bit. So it's like this seesaw. So that's why we're not concerned when rates go up or down.
Got it. So Canadians can benefit then from the best of both worlds. Like in the U.S., their primary residence is not exempt from capital gains. In Canada, it is. But in Canada, as you said, we can't just deduct the mortgage interest that easily. But with the Smith maneuver, you can benefit from both in Canada, which is interesting. Now, in order to benefit, do you have to meet certain requirements? So when you do walk into a branch of the Big Five banks, you ask for that re-advanceable mortgage. But then when it comes to talking to your tax accountant, complying with the CRA rules, what do you have to know? Like, what do you have to do and say, and just to stay on side for this to work?
Well, in order to stay on side, in order to be set up with the right type of mortgage, because there are a number of different readvanceable mortgages out there. All the banks carry a readvanceable mortgage, but they're not all created equal.
Mm-hmm.
They're all different somehow. The most important thing to do when starting off here is not to go into the bank branch and ask for a readvanceable mortgage, because as we talked about earlier, they're going to sell you their readvanceable mortgage. You're going to say, hey, I need a readvanceable mortgage because I want to do the Smith maneuver. And the salaried employee who sells mortgages is going to say, we have a readvanceable mortgage, but I don't know what the Smith maneuver is. And now you don't have someone to follow you and guide you along on your journey. And their mortgage product is probably not the one best suited for you, because there's a number of accelerators, everybody's that we can use. And with some types of readvanceables, you can't access the full potential of the accelerator. So this is why I created the Smith Maneuver Certified Professional Accreditation Program, which is a bit of a mouthful, but we've got well over 100 specifically trained financial professionals, mortgage brokers, investment advisors, tax professionals, insurance, realtors, all the different types of professionals which are involved with your home and your mortgage and your financial well-being. They've specifically been trained in the Smith Maneuver. So by going to these SMCPs, we call them, Smith Maneuver Certified Professional, they'll look at your situation and say, you know what? That's not the best readvanceable mortgage for you. This one is. And what might be best for Mary might not be best for Jane, right? Yep. And then when it comes to the investing, when it comes to the tax preparation, your tax return, you do not want to submit an incorrect tax return when you're doing any sort of financial strategy. You want to make sure that your financial professional understands what they're talking about. And in the case of taxes, you want to make sure you're not overclaiming deductions. You want to make sure you're not underclaiming deductions. So the worst thing that any Canadian homeowner can do is go to their existing financial advisor, go into their bank, talk to their accountant and say, hey, I want to do the Smith maneuver. And they'll say, well, I don't know anything about it, but I'm sure I can figure it out. And that's not what you want to hear. Right? And the nice thing about all the professionals in our network is that, if you're in Toronto, we've got mortgage brokers, investment advisors, tax professionals, and they all know each other because they're all in the same network. And so they can surround you like a nice warm blanket when it comes to all the different aspects, the financing, the investment, the tax preparation. You want to buy your first rental property, which the possibility might be opened up because you're engaging in a strategy. We've got realtors, and they all know each other.
Yeah. How do people access that list of Smith Maneuver, approved?
Yeah, on smithman.net, we've got a tab that says "Find a Smith Maneuver Certified Professional."
Excellent. So the other side of obviously the Smith Maneuver is again going back to the point of investing wisely, because you can invest in assets that go down in value. You brought up the Audi or BMW example. Definitely not an asset liability. Do you detail that in the book? Like, what would be the best avenue? Like, are you investing in dividend stocks? Is that how you qualify? Do you have to be paid in income? Is that what the CRA sees? If you want to deduct basically your interest from that HELOC that you're pulling.
And this is another reason to use someone who is an expert in the strategy, like on the accounting or financial advising side, because there are rules which govern whether you can or cannot deduct the interest on money you borrow to invest in a certain asset. The rule is there a reasonable expectation for generating income? And if there is, then you can deduct the interest on the money borrowed to invest in that asset. The challenge is there are certain investments where you would think that I'm investing here for my future, and it's a growth-oriented asset I'm buying, and I go to claim the tax deductions because on this borrowed money, and the CRA says no. Well, why, right? And it's because quite likely you haven't consulted a financial professional who will be able to indicate that one do qualify, but this one doesn't. Oh, really? I didn't know that. I thought it would.
Yeah. So
it's very important, again, to talk to financial professionals who understand all the different aspects the strategy entails.
Absolutely. Do you have success stories of people that you've heard who've read your book, implemented it, who've worked with one of your designated financial planners?
The success stories come in all the time. I mean, I was an active advisor from 2006 until 2018. I started under my father, and I learned the strategy, and I took on a client base. I had over 500 families as clients. So yeah, the success stories are out there, lots of them. The key to this is diligence and sticking to the plan, sticking to the program. Once you get set up, most of it can be automated, but it's not 100% automated yet. So it does require action, just like you have to go online and pay your credit card every month. It's one more thing to do, but the benefits are quite astounding if you get into it, if you stick to it, and be diligent.
Speaking of sticking to it, I think you wanted to show us a calculator, right, Robinson, that you wanted to walk us through.
Yeah, let's do a basic definition of the Smith maneuver. I want your listeners to understand what it is the strategy is actually all about. So we talked about the readvanceable mortgage, and the readvanceable mortgage, the limit on that line of credit increases as the balance owing against your house decreases. So effectively, the bank lender is always willing to have you owe them the same amount that they lent you in the first place. What you do with that available credit that is increasing each month is very, very important. And again, we touched on it. You want to invest with the reasonable expectation of generating income. And the beauty of all this is that your neighbor might have the exact same house, exact same mortgage balance, exact same rate, all of this, but they're not implementing the strategy. And you are. And now you're investing $900, $1,100 a month, whatever it turns out for your situation, and they're not. So over a 25-year amortized period of time, investing $1,000 a month, generating these large tax deductions, using the refunds to pay down your mortgage each year, and then pulling that out to invest. You're getting rid of your non-deductible mortgage debt faster, you're reducing your tax bill, and you're investing now, not later. Your neighbor is not investing $1,000 a month, and it doesn't cost anything to do this for the homeowner. All we're using is the regular mortgage payment that you're making anyways. So, as we talked about, you pay it down $1,000 a month, whatever it is, you borrow it back and you invest it, and you do that each and every month. Pay it down, borrow it back to invest. You take your tax refund, tax time, you make an extra payment against your mortgage, which your neighbor is not able to do because they're not getting that refund. So the result is, for a typical Canadian homeowner, we're seeing a reduction in amortization of about 3 years, maybe 4 years. So instead of a 25-year mortgage, 21, 22, and a net worth improvement of $300,000 to $400,000 over that amortization period. Mm-hmm. Again, with zero extra dollars coming from your pocket as compared to your neighbor. So it's, for not costing you anything, it's a very large benefit, but that is just the plain Jane Smith maneuver. That's as basic as it gets. And there are a number of accelerators, and almost every Canadian will be able to take advantage of at least one of these accelerators, some more than that. And the accelerators, we'll go through that as we go through the calculator. I'll explain them. Mm-hmm. So let's see if I can figure out a share screen here. Okay, are you seeing that?
I can see it.
Okay, perfect. So this is a calculator that I've developed, and it's only Smith Maneuver certified professionals have access to this, so they can run your scenario with your numbers. But using a fictional case here, we'll say the homeowner earns $150,000 a year. Just for simplicity, I'm not going to add in investment income or pension income, but they do have a rental property, and the annual rental income is, let's call it $36,000 a year. They're taking in from their renters. They don't need any of this rental income for living expenses because they're employed, as we saw, making $150,000. The rental expenses on this property, let's call it $32,000 per year. So that's the mortgage, the maintenance, property tax, all of those things that come with owning that business. On the asset side, this fictional character has, let's just call it $30,000 worth of mutual funds already existing. Their investment property, it's $700,000. And emergency funds, they got $20,000 put aside just for emergencies. On the liability side, let's just say they've got $350,000 mortgage balance on the rental property. So based on the numbers that we've put in, marginal tax rate is approximately 40%. This is going to change depending on which province you're in, but we'll leave it at 40%. So we've got their income, we've got their assets here. Now what about their principal residence? They've got an $800,000 house. This is the one in which they live. They got a $550,000 mortgage on that at a rate of 4.8, let's say. And it's amortized over 25 years, which is the default here. So there's their monthly payment. That's what it's going to be. Now, as we mentioned, these types of mortgages have a line of credit that's attached to the typical amortizing component here. And they, as I mentioned, they speak to each other. When one balance goes down, the other limit increases so you can pull it back. Let's say prime is 5.2, and typically the readvanceable lenders will say, okay, it's prime plus a half for the line of credit. So 5.7% over there. Just want to expand a couple here. This calculator defaults to 8%. Their investment portfolio is going to grow at 8% over the course of time. And this indicates that based on these values, this client can invest $749 as soon as he starts getting into this strategy. So, yeah, I do want to invest all of that. And that starts to show improvements here. Well, on the taxation side, that's just generating right there $246,000 over the amortization period in tax deductions based on his marginal tax rate. That's $100,000 that he'll receive in tax refunds. And a net worth improvement of $200,000 because he's starting to invest, right? Now, yep. We can improve this, and it gets a bit complex, and this is why only SMCPs have access to this, but we can play around with the amount that this client has to invest each month by playing around with the amount of total mortgage he wants. If he only accepts $550,000 as his global limit on his mortgage, which is what he needs, he can invest $906 a month versus what we talked about earlier. If he accepts the full 80%, $749. We're going to say he's going to limit the amount that he wants from this lender. Not 640, sorry. Let's go all the way down to $570,000. So what this is saying basically is that with these values, he's going to be able to invest $870 a month. Now we're going to take these tax deductions that we've generated through this borrowing to invest, these tax refunds more specifically, and over the course of time each year, he's going to apply that tax refund as an extra payment against his mortgage, pull that out to invest as well. Yep. And this is where we see an amortization improvement. Because since he's overpaying once a year with this new money from the government that he doesn't have to come out of pocket for, instead of 25-year amortization, that bad debt's gone in 21 and a half years. So he's saving 3.4 years. He's also increased his net worth improvement to $441,000. What this is saying is he's got an investment portfolio at the end of that 25-year AM worth $950,000, but offset by that deductible investment loan that we've created as we've converted that debt from bad debt to good debt. So he can be clear title and still have a $440,000 net worth improvement. And this
is great.
Yeah. So this is simply the plain Jane Smith maneuver. Now we get into the accelerators. And I entered earlier that he's got $30,000 worth of mutual funds. He can, if he wishes, he's going to want to look at taxation here. Does it make sense to redeem these mutual funds from capital gains perspective? But if it does, he can sell his mutual funds, take that $30,000 in cash, make an extra payment against his mortgage, and then because that line of credit limit will increase by that same $30,000 that the mortgage declined by, he can pull it right back out and invest it again. He can buy the same asset he just sold a week earlier. He can buy a different asset, whatever he wishes. But now we see a better improvement in the reduction in amortization. In
Mm-hmm.
19.3 years, that bad debt's going to be gone, and his net worth has improved to $690,000. He can enter in future lump sums. If he knows in a year and a half he's going to get an inheritance of $100,000, he can add that in here. We mentioned that he's got $20,000 in emergency funds. If he wishes, he can take all of that or some of it and make an extra payment against his mortgage today, pull that back out and get it invested, and we see 5.67 year improvement in 690 go to 6.5 and 765.
Mm-hmm.
Cash flow diversion. If this guy says, you know what, I can come up with an extra $200 a month, I make a good living, I'm going to make an extra payment each and every month against my mortgage, above and beyond my mortgage payment, $200. 6.5 to 7 and 765 to 8.17 and 972. Now I want to show you the results that we can see without having to come out of pocket any extra dollars. So I'm going to zero that back out. Cash flow dam accelerator. This is where we see some really big improvements here. This guy's rental property, his renters pay him $3,000 a month,
Mm-hmm.
but it costs him $26.67 to service the expenses on that business, that rental property. But what he can do, what most Canadians do, is they'll take that $3,000 a month and then they'll turn right around and make the payments on that rental property. But they're missing out on a very valuable opportunity here, because what he can do is take that $3,000 a month and make an extra payment against his own mortgage, against the non-deductible mortgage debt on the house that he lives in. He's making an extra above and beyond his regular mortgage payment, right? But again, that HELOC limit will increase by that $3,000. $26.67 of that gets reborrowed to service the expenses on that rental property, and the difference goes to invest in securities because he doesn't need it for living expenses. And once he implements this strategy, this accelerator to the Smith Maneuver, his mortgage debt of $550,000 is gone in 8 years.
Wow.
So he saved 17 years. And his net worth improvement shoots up as well, of course. And with the taxation here, it's $262,000 in tax refunds that he'll receive over the course of this 25-year AM that otherwise he would not receive. And then the dividend reinvestment plan accelerator, he can take any dividends that he may be making, and instead of automatically buying more shares of the company, he can take the dividends in cash, make an extra payment against his mortgage, pull it out to invest in the exact same asset that sent him those dividends to begin with, if he wishes.
Yeah.
Now, based on what we're looking at here, he has immediately available credit of $20,000 as soon as one of our SMCP mortgage brokers refinance him into the best mortgage for himself. He can, if he wishes, take that $20K out right away and get it invested. And if he does so, then we see improvements across the board again, 17.33 and net worth improvement of 1.3. But the calculator says if you borrow that $20,000, this is new borrowing. This is additional borrowing above and beyond the mortgage that you got when you bought your house. And because none of the other accelerators involve acquiring more debt. All they're doing is converting bad debt to good debt, the debt that you already had, that mortgage debt. But if you want to borrow, client, $20,000 more, increasing your total debt, then we're going to make you pay that related interest out of pocket each month. Because if you can't afford to pay it out of pocket each month, maybe you shouldn't be borrowing this extra money in the first place. And so this calculator says to borrow $20,000 will cost you $95 a month. So you're going to take that $95, make an extra payment against your mortgage. That $95 will then become available on that HELOC once the limit increases. And when that gets pulled out, it's going to service the interest on that $20,000. So with what we've seen here, he's generating $670,000 in tax deductions over the course of his amortization, whereas he would have received zero tax deductions if he'd not engaged in the strategy. And based on his marginal tax rate, that 672 leads to over $250,000 in tax refunds over the AM. And instead of 25 years to get rid of that non-deductible mortgage debt, it's gone in 7.7 years. And his net worth improvement, he's got an investment portfolio with $1.8 million. We offset the fact that he's got a deductible line of credit generated by this strategy. So his net worth improvement is $1.3 million. So Then we've also got a graph, and this just explains what's happening in this particular scenario. This green line here is his amortization going down over 25 years without implementing the strategy, and this blue line here is the new amortization, the new reduced amortization. But as fast as this blue line is going down, as fast as his mortgage is melting away, he's borrowing tax-deductible debt on the HELOC side, right? That's the purple line, so they're mirror images. But they total all the way across this yellow line, which is the total debt line, right? The red line here is his investment portfolio value. So here, when the red line and the yellow line meet, this is where he is theoretically mortgage free. Here, he's completed the conversion process. The 100% non-deductible debt is fully converted to tax-deductible debt. But here, at year 13, he's theoretically mortgage free, because he could sell all his assets that he's generated through the strategy to pay off all the debt against his house. Realistically, we pull this out a year or two, there's capital gains he can expect to pay on that portfolio. But if we're looking at year 14 or so of being mortgage free, it's a heck of a lot better than 25 years.
Yeah. It's an incredible outcome. It just seems like a no-brainer, right, Robinson? But are there any downsides or risks for the average Canadian to actually execute on this for, let's say 15 to 25 years of their mortgage paying life?
Yeah, there's interest rate risk. I mean, technically, you already incur interest rate risk as soon as you get a mortgage. You're assigned a rate, so you've got rate risk there. But we're also now getting a second component against our house, and that HELOC has a rate as well, and that floats with prime. So that rate can go up depending on what the Bank of Canada does. Now, as we talked about before, the higher that rate, the more your tax deductions are, leading to a bigger tax refund, leading to a bigger prepayment, leading to a bigger reborrowing to invest, leading to a shrinking amortization, faster shrinking amortization. So, but there is rate risk. Risks go up and down. Market risk. You kind of asked me earlier on what would people invest in, what do you recommend, and all that stuff. I do not recommend any investments. I'm not an investment advisor anymore. What this strategy does is it frees up the funds to invest. You decide, along with your advisor, what you want to invest in, what you're comfortable investing in. Do you like real estate? Do you avoid real estate? Do you like equities? Do you avoid equities, right? You make that decision on what you invest in. But whatever you invest in, hopefully it's not your cousin's internet startup, right? We're talking about your family's future well-being. So go in something that's relatively safe, relatively conservative, proven track record. It's not a guarantee of future success, as we know, but don't gamble with this. But again, whatever you invest in, unless it's GICs, you could see the value go up, you could see it go down, and you will over time. It'll go up, it'll go down. But both market risk and rate risk are greatly reduced considering the long-term nature of this strategy, which is till the day you die. Right? Yep. This is as long as it gets. And so those risk curves are greatly flattened out. One of the bigger risks is using someone who doesn't fully understand what they're doing. There are a lot of mortgage brokers out there. There are a lot of investment advisors out there who say, yeah, I read Fraser's book 20 years ago. I get it. A lot's changed since then. So use a financial professional who understands the strategy here. We're talking about maintaining your brand new Ferrari. Go to the dealership. We're not talking about a 20-year-old Camry where you can just go to a mechanic and be fine, right? Behavioral risk, and I touched on this earlier. Yep. I had lots of clients when I was advising, and the monthly activity, the monthly action required is not hard. You go online, a couple buttons. But people go on vacation, and they're on the beach with a Mai Tai, and they forget to do their transaction that month. And so just it's human nature to sort of, if something's boring, forget to do it. Sort of thing. Because it is boring. It is not boring when you're watching your investment portfolio go up, your mortgage melt away, but it is, I got to get on and do that transaction. But you have to stick to it. And then probably the biggest risk of all is doing nothing.
Yep.
We know, we're paying close to half of our income in taxes in Canada, federal, provincial, municipal, at the pump, the grocery store, everywhere. Pensions are woefully inadequate, and they're not infallible. A lot of uncertainty out there, wage and salary increase, it's not keeping up. We're faced as Canadians, if we do nothing, with pretty dismal retirement outcomes, being reliant on your children financially, having to live in their basement, having to work in retirement. Go to Costco and McDonald's and you'll see a lot of senior citizens working there, not because they want to, because they have to. Yep. And that is because, inertia is a very powerful thing. And when these people were growing up, they heard from everyone around them, wiser and older, be mortgage free by the time you retire. And so what did they do? They focused on getting rid of that mortgage as fast as they could. And because they're focusing on getting rid of that mortgage and limited resources, they weren't investing. And so they hit retirement age and they're in trouble. And a lot of them sign up for reverse mortgage. And what does that look like? Well, you've worked for the bank for 40 years so that you could make your mortgage payment. You hit retirement. You look, I don't have retirement income. I'm going to sign up for a reverse mortgage. Boom, you start selling the house back to the bank after working for them for 40 years. Right? So, we're glad reverse mortgages are there and that they exist, because who else is going to lend money to a retired senior citizen, right? Nobody. So we're glad that the people who need this have access to it, but we want to be able to avoid that. And you ask a lot of Canadians these days, what's your retirement plan? What do you got going on here? Well, I don't know. I don't really have a retirement plan. I've got a house and I'll probably use that some way when I hit retirement to help fund it. Okay, well, you're planning on using the equity in your home to finance your retirement anyways. Start using that equity now, not in 25, 30, 40 years. You're missing out on the power of compound growth. You're missing out on deductions. You're missing out on getting rid of expensive non-deductible debt sooner. So
it's crucial, obviously, for viewers who are interested in the Smith Maneuver to contact a qualified planner, financial planner. But they might also be thinking, how much am I paying them, and how long will I be paying them fees to help me carry out and execute the Smith Maneuver? Can you maybe talk to that on average?
So when you go to a mortgage broker, every mortgage broker has the same tagline, right? We work for you, not the bank, right? And that's kind of true. But the mortgage broker gets paid by the lender, right? If I'm a mortgage broker and I get my client a mortgage from RBC, RBC will pay me. So the mortgage brokers that we have in our network don't get paid by the client. Some of them offer services to really stay with the client and be there long term to help them out, in which case they may have contracts which you can elect to sign or not. But mortgage brokers in general get paid by the lender. You talk to an investment advisor, which everyone should anyways, I believe, rather than try to do the investing on, if I'm a school teacher, I'm a school teacher, I'm not an investment advisor, so I go get help. And they're not going to charge you any more as an SMCP than the same type of advisor across the street would charge. So there are fees for some of the services which Canadians pay to utilize anyways, but the homeowner does not pay the Smith Maneuver. They do not pay me. I provide a connection service for them. They can go to the website and say, click the button that says find an SMCP. They submit the form, then I connect them. And I wish them luck, right?
Yeah, that's good to know. That's probably like a roadblock that people are thinking about, and you clear that up, obviously. So you're offering a great resource. Let's get into a little, personal life and background. Robinson, your father, Fraser, recommended that you learn the Mandarin language when you're very young. Why did he say you should do that?
I was, many moons ago, I got accepted to a few universities. Two of them were in Vancouver, which is where we all lived at the time, and one was in Victoria, and I said, I'm going to Victoria because it's a boat ride away from my parents. So I went to UVic, and I told my dad, I filled out all the pre-commerce, that sort of thing, first year. But I filled out all my electives except for one. I don't got any advice on what I should take for this last elective. And he says, well, what are you interested in? Well, I'm kind of interested in languages. So I was thinking about maybe taking Japanese. And he says, why do you want to take Japanese? I said, because everyone's studying Japanese. He says, well, maybe that's why you don't want to study Japanese. How about Chinese? I went, what? Chinese? I can't make my voice do that. I've heard them speak, right? But I took it. I loved it. It was my favorite course by far. And so I just kept on that journey, and I went, after a little while, I took some time off from university. I went to Beijing. I was there for 4 years learning Mandarin, and went back to UVic. I got a scholarship to go to Shanghai for a year, and so I was in Shanghai. And then after graduating, I went and worked in China I was there for about six and a half years working apart from studying.
So you're completely proficient. You're fluent in Mandarin.
No, it's quite a complex language, and there's something like 500,000 different characters and words. So no, I wouldn't call myself fluent, but if you take me to dim sum, I can make sure you get the good stuff.
What's next, Robinson? Is there a sequel to the book coming out? Is there a podcast you're launching yourself? What projects are upcoming?
Well, I don't know is the answer. Right now, we're getting so many requests from financial professionals, mortgage brokers, advisors, etc., to join the network, to come into the network, to be able to offer this service to their clients. Because mortgage brokers especially, they'll get a phone call and hello, I'm Bill James, mortgage broker. How can I help you? Hey, I want to do the Smith Maneuver. Have you heard of it? I've heard of it. I don't know much about it. Right. So their clients are starting to ask them about it. So they're coming to join the network. So we're really busy building out the systems and processes which can handle the increasing number of professionals who want to offer more for their clients. It's all about strategy these days, right? It's not about best rate.
Yeah.
Financial strategy is wholesome. How am I going to improve my finances? So building out the network right now takes up quite a bit of my time. Also, more and more Canadians are writing to the website saying, connect me to an SMCP so they can help me implement this. So as far as a second book, I'd love to do one. I haven't really gotten around to it yet. So I don't know.
Yeah. More needs to be taught in schools, right? I think you'd agree that the school system is lacking in Canada when it comes to basic personal finance. Do you have an opinion on there? Are you helping to lobby maybe for more curriculum that's focused on finance?
The amount of financial education our kids get in school is atrocious. And then their first experience, they move out of the house and maybe they go to university and they're finally free, and they go out and on the field they see these little booths from all the banks. Hey, get your credit card, right? They get their first credit card. So the basics of personal finance are woefully lacking, which is why we have, to a good degree, such a challenge with people who are coming to retirement and the lack of retirement savings, because it's been that way forever. So there is tremendous need for kids in school to be exposed to personal finance, for it to be made fun, to learn about credit, to learn about mortgages, to learn about car loans, bank accounts and credit scores and all of that. Is severely lacking. And this is one thing that I have been noodling is how do we bring better financial education to our kids? I mean, does it look like that's being offered in our school system? Is there an outside third party offering something that is fun for the kids? Even the very young kids, to get the basics ingrained in their heads. Not necessarily ingrained, but an awareness that there is something to learn there. And if we can make it fun, then they continue their learning throughout their young adulthood.
Absolutely. Well, it's been a lot of fun. Robinson, I really appreciate this. You're carrying on the legacy, and I think you're helping Canadians not only pay down their mortgages faster, but also build a portfolio while they're doing it and increase their net worth. So this is great. Thanks for the conversation.
I always say a financially better off Canadian is a financially better off Canada. So,
yes.
And whether it's the Smith Maneuver or not, just everyone, I encourage you to just take an interest to the degree that you can in personal finance and get that journey going.
Absolutely. Well, thank you, sir. Have a good day.
It's been a pleasure. Thanks, Robin.